Initial observations direct attention to a long-term uptrend, experiencing a sharp correction. This is also a nice example of a volatile gap up fill in late August. On closer inspection, there was a head and shoulders at the root of the sharp drop. It is a slanted variant with an upsloping neckline, relatively symmetrical shoulder level, and a flat head. It is not unusual for charts to gap up near the site of clear resistance and support, such as the gap up that is followed by a trading range in the 3750 to 40 area. These happen to be where downswings formed the head and shoulder levels of the previously identified head and shoulders. 3750 is the focal point of a brief support range. It is also an approximate gap up level. Most gap ups can be defined by the initial gap up candle, and the next few candles after it that may form up or down swing points. That's why the Morningstar price action at the end of June is still within the gap up support range, despite dropping under the exact 3750 level. After breaking to new record highs with moderate strength, there is major selling pressure and volatility to begin a possible downtrend. Thus, the 40 level is now the center of key support. After the peak in early July, there were 3 minor downswing points with increasing volume. It was a likely descending triangle to accelerate the early downtrend. However, the end result was a failed descending triangle. 40 held strongly after the minor gap down on August 16th. That led to a large harami, but no clear breach under 40. Moving back up to the trend line and the minor gap down fill into early September, saw a consistent rise with modest bullish volume. This might have not been enough to reach new highs were it not for the near absence of selling after the bearish sentiment had largely been expended in August. Note the downtrend lines are drawn to encompass more area of the downswings, that being the open, high, low, and close prices. This is not necessary in all cases, but is highly useful during volatile periods, especially with large real-bodied candles like in early August. And it was a bonus to see high volume at the beginning and end of the pattern, especially at the end during the move under 4250, which conveniently lines up near the low of the minor upswing in mid-October. It even runs near the open of the bearish engulfing in July. Incidentally, the bullish reversal is at the old 3750 area, to show the residual influence of past patterns at this price range. It is not unusual, but less common to see the trend lines from the failed descending triangle remain influential during the bullish reversal back into the upper 30s and beyond. The long-term uptrend is so strong, the gap back up into the mid-40s in early 2017 is not filled. The mid-60s range naturally becomes a strong support, due to the high concentration of swing points and roll reversal. This is why it is a crucial lower boundary after the break of the upward channel. It is a double or triple bottom depending on if you count the long lower wick at the start of May. Nonetheless, it is a bullish reversal range that had additional detail about its lower boundary by directly using the open, high, low, and close prices of the candles comprising the upswing areas. This was not necessary, but more of a demonstration to zoom in on the shorter-term perspective. A failed double top takes place in May, in a range that centers around the 72.91 level, directly taken from the close of the first minor downswing. This area is also significant as it was from the region of a swing point in the upward channel, and the breaking point of the upward channel. The early 2017 gap is finally filled and provides tremendous support to the volatile drop. This is especially true for the 4250 level from May to June. That is the site of a minor gap up fill that forms a double bottom. Two patterns combined like that increase the strength of the price action. In this case, it is advantageous for a steep incline in early June, with relatively moderate volume. It is largely a prolonged period of horizontal ranges gradually sloping up. The more recent gap down, concentrating around the opening price of 55, offers sustained resistance, but the uptrend holds firm. There are periodic bullish spikes to begin filling higher into the gap. The gap fill beginning around the closing price of 63 offers relatively minor resistance. Most of the selling pressure comes a bit higher around 64. And the overall sharp drop was more a result of the broader stock market decline in 2020, rather than Activision's stock itself. This is further evidenced by the speedy recovery back into the lower 60s that still offer resistance, but not for long. The area around 72.91 marks the more recent gap up that was filled. This helped stabilize the uptrend to retain an aggressive but stable incline. It also provided more advantageous conditions for the lower 70s to reverse rolls and offer crucial support during the downtrend from August.